Every day we're getting closer to a major stock market crash or a financial crisis or both. And I think the only thing that might derail this in the short run, of course, nothing is going to derail it in the long run. This crisis is inevitable and will happen. But Powell is going to have to come out and do something drastic to change this narrative. Otherwise, this is going to happen. And, whether it's tomorrow, the next day, the next week, it's hard to tell. But what seems apparent to me is that we're about to go over a cliff. Just don't know how much, more distance there is between where we are now and the edge of that cliff. But we're going there. What's going to push us over the edge is the rise in interest rates, the collapse in bond prices, which is continuing relentlessly. Now, this is not something that should be a surprise to any of my podcast listeners. I have been warning about this not only in recent podcasts, but over the last several years, that this was going to happen, that interest rates were going to rise a lot more than the markets were prepared for. Not only rise a lot more, but stay higher for a lot longer. And that is what we're seeing now in the bond market. Bonds now are at their highest yields since before the 2008 financial crisis. If you look at the yield today on a 30-year Treasury, it closed at 4.7%. Now, that's still a very low yield, but again, we haven't had yields this high since the 2008 financial crisis. The yield on the 10-year is 4.56. Now, we're getting very close to 5%, which is still a low rate, but most people might not recognize this, but the last time the 10-year Treasury yielded more than 5%, it was 2001. And the yield got to like 5.2 or 5.3, so it barely got above 5%. We are almost there. Now, there's a big difference because back in 2001, I think the national debt was 7-8 trillion. Now it's 33 trillion. We have a lot more debt now than we had back then. So this is a much bigger problem, a 5% 10-year. I mean, we're not there yet, but at the rate we're going, we will be there soon. And what nobody seems to appreciate in the financial media is they are looking at the beginning of the end of this whole phony economy, because the economy is built on a foundation of cheap money. It's not just the economy, it's every facet of it. The government, the deficits, the government budget is built on cheap money. And it's not just the federal government that's been gorging on this cheap money. A lot of the state governments, municipalities, they've all issued a tremendous amount of debt over the last 15 years. That's about how long interest rates were at zero, except for the last year. Again, remember, what was everybody saying when money was cheap? Great time to borrow. Take on debt. It's cheap. Borrow. Everybody borrowed because it was so cheap. And what was I saying for years? This is a mistake. I said, just because it's cheap doesn't mean you should do it. My analogy was, should you do heroin if it's free? Oh, look, I can get all that free heroin. How can I pass that up? No, just because it's free, it doesn't mean you want to inject it into your body, because eventually it's going to cause a problem. And that's exactly what's happening now. I knew that all that, cheap money would come back to bite the people who borrowed it, because eventually interest rates would go up and the debt would still be there. And then what would they do? Well, we're going to find out, because it is a disaster in the making. I looked at the yield now on a mortgage. It's now at 7.9%. We're almost at 8%. I was predicting this. I was calling for this to happen. There are a lot of people, when the yield on the Treasury bonds just got up to 4%, oh, this is a great buy. You got to buy these bonds. A lot of these bond investors, oh, these are great yields. It's a great opportunity. Buy the 10-year bond. You can get a yield. It's all the way up to 4%. And I was saying, well, what's so special about 4%? That's not a good yield. That's horrible, especially where the inflation rate is. But the whole basis of believing that 4% was attractive was based on the last 15 years of 0% interest rates and the belief that 0% interest rates are just around the corner. That as soon as there's a problem, as soon as the economy slips, the Fed's going to go right back down to zero. And then if you're holding those long-term bonds, you're going to make a lot of money, just like people have in the past. Well, it's not going to work this time. In fact, people who have been holding bonds, they're down about 50% on their money from the peak in 2000. Bonds are getting killed. Bonds are down more than stocks this year. In fact, I don't think stocks are down, although they're down about, NASDAQ, I think, is now down 8.5% from its highs. But I think bonds are down maybe 10, 11% on the year. So minus whatever you got in interest, you're losing money on bonds on top of the worst year for bonds practically ever last year. In fact, this will probably be back-to-back the two worst years in the history of bonds. And I said that. I said that last year. I said this would be another down year last year. All the people that were saying, buy the dip in bonds, I said, no, the dip isn't over. It's going to be a lot worse. And in fact, bonds are likely to have another down year in 2024 because they're still not high enough. Look, the yield on a 6-month treasury is 5.5%. We're still, even after this big rally, only 4.7% on a 30-year. That's not how a yield curve works. It's positively sloped. Now, yes, usually at the beginning of a recession, you'll get an inversion of the yield curve where the long end would be below the short end. But under normal circumstances, when you're not in a recession, and everybody claims that there's no recession, that we've got this resilient economy, that may be a soft landing, but not a real recession. Well, if that's the case, the yield curve needs to normalize. So if you can get 5.5% on a 6-month, if you just look at the average premium during the 80s, the 90s, 2000s, up till 2008, if the 6-month treasury is at 5.5, and it's actually a little higher than that now, a 30-year should be 7.5 at least. Well, we're at 4.7. We have a long way to go to get normal long-term interest rates, except they shouldn't be normal. The yield curve should be even more positively sloped now, because the difference between the yield on a 30-year treasury and a 6-month treasury is almost an extra 30 years of risk. What is the risk? Well, let's just take default off the table, right? Assuming the government's not going to default. And, who knows? I mean, it could default, but let's just forget about that. The real risk is inflation, that your money will be worth a lot less in 30 years. Now, if you're loaning the government money for 6 months, I mean, how much less could it be worth? I mean, even if you have 10% inflation, over 6 months, that's only 5% that you lose. But if you have 10% inflation for 30 years, by the time you get your money back, there's nothing left. So when you have higher inflation, you need an even bigger premium to loan the government money for 30 years, because you're taking 30 years of risk. Now, what are the factors that determine the inflation risk? It's the size of government deficits, because the bigger the government deficits are, the more inflation that the government is likely to create. So when you have large fiscal deficits, you would expect to have a higher premium on longer term bonds. And so to go back and look at what has historically been the average, no, not today, when you have a historically abnormal amount of debt, when you have $2 trillion budget deficits as far as the eye can see. In fact, as far as the eye can see, the budget deficits go a lot higher than $2 trillion a year.